Hey everybody, welcome to the Module 1 Quick Hits video. So this is going to go over the key concepts from our Module 1 content as per the textbook. And a really good thing is to have your reading done ahead of time so we can just kind of have an overview here to solidify the things that you've learned thus far. So first things first, we'll go over to Chapter 1. This is the Private Equity Essentials. The key information that we need to know about the industry. So what is private equity? Well, private equity is essentially the investment of capital into privately held entities or assets. So most of the work you've done thus far in your education is likely related to publicly traded entities. Now we're moving into the private market. Okay. There's a difference here. There's private equity firms, and those are the entities who run funds, and funds are the entities which invest in the targets. Okay. And there's also a difference between GPs and LPs. So GPs are the general partners and LPs are the limited partners. And we'll go through this big chart in a moment to kind of show the differences between the two. But GPs, LPs, those are part of a limited liability partnership organizational structure. So as you can see here, we've got our private equity firm acts as our sponsor for any deals or for the fund itself. And they operate the general partner who essentially controls the fund, has all the voting power or most of the voting power, and carries all the liability. The LPs, the limited partners, are the investors. The extent that they can lose money from the investment going wrong is limited to their initial investment. So that's why they're limited partners. The general partner, their liability extends beyond what their investment is. Okay. The private equity firm also acts as the investment manager and provides advisory services to the fund. They also work with the sub-advisor in the management of all the investments. So in this case, this fund has 4 investments, 4 portfolio companies. Okay. And the way that the capital gets into the fund that can be deployed into investments is most of the capital comes from your limited partners. So they're investing. The private equity firm and the entities controlled by them manage the fund and are attempting to provide a high return for not only themselves, but the investors that invest in the firm. Okay. So the private equity life cycle starts with fundraising. So you've got to raise capital from all your LPs. This is the capital that you will then deploy into investments. And you can see that fundraising not only starts before the investing period, but past it. So this is where when the investment's executed, you might have a case where the private equity fund continues to raise capital, and that capital pays down a little bit of the debt that they used to acquire the investment. And the private equity fund will keep fundraising until they hit their target raise number that they've set in advance. Okay. So the investment period lasts for the first little bit. That's when you're acquiring portfolio companies. So that might last for the first, 1 to 5 years of existence. So this is your deploying of capital into multiple investments, typically. Then there's the hold period. This is where you're working to grow the value of the investments, reaping the rewards of the cash flow from these investments. And then you begin exiting your investments. So divesting of them, selling them off, and repaying capital to your investors. Okay. So how big is the industry? Well, one measure of the industry size is the amount of what's called dry powder. So dry powder is all that capital that's been raised by funds that is not yet deployed into investments. So we can see in this chart, it goes back to the year 2000 up to 2015. We can see some substantial growth from between 2004 and 2006. And this in 2015, it was the highest amount ever. And it's, higher than 670 or so billion dollars. Big, big stuff. So the life cycle, a private equity firm can have multiple simultaneous funds operating underneath them. Typically what happens is investors from fund one may use returns from fund one to invest in fund two, or they might have to wait until a further successor fund. So maybe fund one, they invest in fund three or four. It depends on what capital you have on hand. But typically, there's a life cycle where you have more than one operating at the same time, and you provide a lot of opportunities for your investors to hop in. And, especially if you're performing well, your investors will be happy to give you more money so you can put it to work. Now, the economics. So how does the money work? Well, if we look at the left-hand chart, so this is the same chart as earlier, but now we are showing not influence, but the fees. So a management fee is paid by the limited partners into the private equity fund, which then part of it flows through to the investment manager, which is an organization developed by the private equity firm. And the GP, general partner, earns what's called carried interest. And that is a share of the profits earned by the fund. So these are the profits that come to the fund from the portfolio companies. In addition, the sub-advisor is taking transaction monitoring fees from the portfolio companies. So the sub-advisor may take a slice of the transaction fee for putting the transaction together to actually get the investment in the first place, for example. Okay, so looking at carried interest specifically, this is the chart on the right-hand side. So you've got your total invested capital and the profits in red, and this is how it's typically split. So in step one, all the investors get their original investment back, and we're assuming that the total invested capital and profits are a lot more than what that original investment was. So investors get all their money they put in back, and then the step two happens where they get a hurdle rate. So it says, of the returns, the first 15% goes to the LPs. Okay. Then you move to step three, and this is usually called the general partner catch up. So if the profits hit that, say, 15%, then the general partner starts to earn their chunk. And that's an incentive for the GP to do a good job with the investments, because they only get paid once you hit above that hurdle rate. And then everything above that GP catch up is split at some kind of proportion between the LPs and the GPs. A lot of time that's 80-20, with 80% going to the LPs, 20% going to the GP. Okay? So you can see, as a firm running a fund, if you do really well, you can really reap the rewards from this process. So that's it for chapter one, quick hits. Chapter two, dig into venture capital, which is a subgroup of private equity. So what is venture capital? So this is where capital raised from investors gets deployed based on this venture capital cycle. So what you're doing with this capital is you're investing in startups, and you do so in stages. You do not typically give huge amounts of capital to the investees all at once. You may participate in multiple funding rounds. You've likely heard of Series A, B, C, D. Those are the sequential funding rounds for private equity, for venture capital. So what happens is staged funding moves into the startups. Then you're going to know it's high risk funding early stage companies. So it's either going to not work out and the capital just goes poof, or you earn a very high return. That high return likely gets cycled through again and provides stage funding for another startup. Okay. Key thing is here that it's high risk. Okay, so what you're hoping is the high returns. Maybe you're earning 20 times invested capital. So that covers all the losses from, say, 8 investments that didn't go very well. Okay, so when does venture capital get involved? Well, obviously, they're not knocking on your door the day after you've created your startup. So the first thing that happens when you create a startup is you get that seed investment period. That's where you're still trying to figure things out. You're not sure if it's really going to go or not. Most of the money comes from your friends and family. Sometimes people call this love money. Or if you're a little bit more farther along, angel investors might contribute. So that's kind of when you're doing your proof of concept time. Once you're proven and you need that help getting to market, getting bigger, that's when venture capital comes in. So you can see the big red arrow here, the venture rounds, that happens during commercialization and scaling up. So that's your series A, B, C, D, and so on, as needed by those companies. Okay, and the venture capital firms are also assisting those companies, not just with the cash, but expertise to really juice up that process of getting bigger, better, and cash flow positive over time. So when you're doing a venture capital deal, the deal terms are very important. So there's economic terms and then there's control terms. And these are to, a lot of the time, protect the venture capital firm in case things go wrong. So the first thing is the share price and valuation. What value are you putting on this venture capital firm? So what value as the venture capital firm and fund are you putting on this startup? How much are you giving them? How many shares are you getting in return? Then comes liquidity preference. So this is, when do I get my money back and in which order if there's a liquidity event? So a liquidity event can be the sale of the company to a large conglomerate. It can be if the company goes public, for example. There may also be terms related to employee share ownership plans. So are the company's employees invest in the company as well? Anti-dilution. So as you know, as successive funding rounds occur, more shares will be issued, meaning that the shareholdings of existing investors become a smaller percentage of ownership over time. So there are terms that you can use which protect your percentage ownership, even if new shares are issued to new investors. Then there may also be conversion rights where you've invested by acquiring preferred shares. You can convert those to common voting shares, or you might have invest with convertible debt, which you can transform into shares later on. Control terms. So do you get board representation? Are there protective provisions in there about your control? And drag along and tag along rights as well. So I'll move my face a little bit. That's a 750 under there, if you're curious. So key considerations. So we've got the characteristics of the rounds in blue. So we've got which round it is. So seed, ABC, the valuation ongoing, how much capital they're raising, and then the equity stake of each investment round that the investor earns. So if you're the entrepreneur, you're thinking about your burn rate. How much cash are you burning every month? And how much of that capital raised, how much runway does that give you? So for example, in the seed round, you raised 150,000 with a burn rate of 15,000 per month. You have 10 months of runway. So you've got 10 months before you run out of money again and you need to raise. Okay. And you can see after the first funding round, the entrepreneur still has a very large percentage of ownership. And then we've kind of got a metric to measure how valuable each percentage of the company's worth. So as successive rounds happen, you're gaining more runway each time. Entrepreneur's stake is going down, but because the company is growing so much, the shares that they own are much more valuable in the end. So this is this runway analysis, and understanding the equity stakes of investors and entrepreneurs shows you how both work hand in hand for the benefit of the business. Chapter 3, growth equity. So growth equity works with minority equity stakes. So the company is, the fund is investing in minority stakes. So it could be 20%, 15, 10, 5. It could be anything that you're comfortable with. Some firms do 49%. Okay. And so the fund provides capital to the company, the target, and the firm and fund also provide expertise to that company to help grow the investment over time, therefore really gaining investment returns for the LP investors. So where does growth equity act? Well, it acts kind of after venture capital is done, but before buyout investors like to get involved. Buyouts we'll look at next. So what this growth equity does is they hop in, they work on professionalizing the company. So oftentimes it's kind of a startup, it's been venture funded, but we've got to standardize the processes. We got to really work on governance still, succession planning, mentoring. Maybe you got to replace the founder with a real manager style CEO that can guide the company and manage it more effectively later on. And the firm and fund will help with new initiatives as well. So market entry, so maybe expanding cross borders, new products, optimizing cash flow. So a lot of times there's some cost cutting to be done in this stage. And there could be acquisition and divestment. So acquiring competitors, acquiring supplemental product lines or services, or divesting and carving out non-core assets to streamline operations. So now we're in the stage of buyouts. So we've got our buyout firm, and they kind of provide they have three direct links to their targets. So they get equity control. So this is a controlling interest. So 50% plus one and more. So sometimes it can be 100%. A lot of times you leave a little slice of equity for management or the former owner, so they stay invested post buyout. Then you use leverage. So you use a lot of debt to perform this buyout, which happens to also increase your investment returns over time. And then you ensure that the management team is aligned with your firm's goals and the way that you want this company run. So buyout value creation. So this is how they get their investment returns. So number one is they repay debt over time using the cash flows for the business. Second, usually when you acquire a company, it'll be at some multiple. So in this example, it's at 9 times EBITDA. Over time, if you grow the company, typically bigger companies have bigger multiples. So if you do a good job growing the company, or by chance this market becomes much more attractive, you'll have multiple expansions. So in this case, it's gone from 9 to 10. So you've earned an extra multiple 1 times annual EBITDA. So that's a big, that can be a big increment. And then third, you get your cash flow and EBITDA growth over time as well. So you can see in this example, the debt starts at 550, equity at 440, total enterprise value of 990 million, in this case euros. Over time, debt was reduced to 300 million. The company as a whole was 1.5 billion, and that leaves the equity now worth 1.2 billion. So that is a big growth. That's an IRR of 28.5%, or a money on money return of 2.7 times. Not bad for 4 years worth of work. So lastly, alternative strategies for private equity. So there's the key ones are turnarounds. So buying companies that aren't doing well and turning them around, investing in distressed debt, doing private lending or private debt, and then investing in real assets. So turnarounds, this is the main process for turning around a struggling business. So before you even invest, you're looking at debt restructuring for the business, gaining asset-based financing for the business, forecasting cash flows, and assessing management. So these 4 pre-deal activities are essentially doing your testing to see if this turnaround will work in your favor or is likely to work in your favor. If you can't restructure the debt or your cash flow forecast doesn't look very good, you're just going to pass on it altogether. So after you do the investment, you're going to change management. You're going to get rid of all the weak managers. They're likely the people who made the company not do well in the first place. You'll get a CEO from externally to come into the company. Likely you'll find someone who's relatively fluent in the industry in which they operate in, so they have some experience, and you'll restore some credibility. So you may have some not so happy customers, suppliers based on the challenges the company has had. You have to work to restore your credibility in that regard. After that, you're going to take emergency action. So you've got to manage your working capital. Likely that was an issue with the company. Drive positive cash flow. They were likely, not making much or negative beforehand. And then protecting all the values of your assets. Then you get into restructuring, where you're just trying to grow the profitability. So cost cutting, restructuring operations, increasing the return on assets and return on investment, and then repositioning resources. So sometimes these companies that are not doing well may have allocated resources to a area which was not optimal, and you're going to reallocate those resources to where they make the most sense. Lastly, you're going to return to normalcy, a non-turnaround business, by emphasizing your return on equity, getting the profitability up, build that momentum again and growth, and then focus on your competitive strengths after that. And I wanted to highlight real asset investment. So you've got a bunch of different asset classes. So real estate, infrastructure, you've got natural resources, and then you can invest at different time periods. So early stage for real estate is the actual construction of commercial space, industrial, could be residential. If you invest in the mature stage, you're operating those types of assets. Early stage infrastructure, that's called greenfield. So that's like pre-build. So infrastructure could be tolled highways. So you're going to be doing the development of that project. Brownfield is operating after the fact. You can think the Port Mann Bridge project, for example, before they took the toll off, obviously. And then natural resources. So early stage exploration development, you can think mining for this, for example, and then mature stage would be your production. So that's it for our Module 1 quick hits. Follow up with the other activities from the module, and I'll see you all soon.